A big thank you. A big thank you for spending your morning with us today. Appreciate your time with us. I'm Priscilla Koo, a member of the UOB AM Invest team, and I'll be your host for this exciting webinar, USD versus major Asian currencies. So before we start, we'll do some housekeeping items for you to take note. If you have any connectivity issues, you can raise them to the Zoom host via the chat box feature. Polls will appear on screen for your selection and results will be shared. Click on the Q&A icon to ask questions throughout the session. Click on the like button to upvote questions raised in the Q&A section. Please note that this is a public webinar, and as you just heard just now, it is recorded. Click on the links available in the chat box to access the UOB AM Invest corporate website and feedback form. Now we're excited to share with you the agenda today. We will start off with a short UOB AM introduction and kick off with our first speaker, Koon Hao, who will be touching on global FX, in particular, US monetary policy and USD outlook. Followed by our second speaker, Peter Chia. He will be going through Asia FX, in particular, what is currently driving Asia. We will end this webinar before lunch with a Q&A section with our special guest, Beng Yu, as our moderator. Kindly raise your questions in the Q&A section found in the control panel. Please note that questions raised in the chat box will not be addressed. Thank you for your kind understanding. Now let's start with a quick introduction for those who are not familiar with UOB Asset Management. UOB Asset Management is a leading regional manager that has more than 30 years of investment experience. We are wholly owned by UOB, one of the strongest banks in the world, and are present in 10 markets in Asia. As of 31st July 2021, we have 38.3 billion assets under management and won 210 awards since 1986. Including the Best Asian Management House Singapore Award recently. I'd like to share with you at UOB AM, our purpose is to create value for our investors, partners, and communities, and to help them achieve their goals and aspirations. Our vision is to be trusted asset manager in Asia, leading in innovation and sustainability. UOB AM is one of the first regional asset management firm in Singapore to join the UNPRI, which stands for United Nations Principles for Responsible Investment. At UOB Asset Management Limited, we have an online corporate platform called UOB AM Invest, and it was launched in October 2018, which offers corporate investors both guided and independent approaches. Digital Advisor, which is a guided approach, offers a customized portfolio based on your company's investment goals, risk tolerance, and investment horizon. In addition, you can adjust your overall risk appetite or the level of exposure for each of the asset classes. Our Digital Advisor is currently available in Sing Dollar only. As for the Fund Direct, an independent approach, it is a self-serve online service where you can make your own investment decisions and buy or sell UOB AM unit trust funds, which are available in Sing Dollar and US dollar. We have hedge fund classes, which will assist to minimize your FX exposure. A little of fun fact. Did you know that UOB AM Invest is Singapore's first digital advisory service for corporate investors? Yes, we are the first and excited to celebrate our 3rd anniversary next month. With a minimum of 200K Sing Dollar, corporate investors can start their robo-advisory journey with us. A few things I would like to shout about UOB Invest. UOB Invest makes corporate investing simpler, smarter, and safer. Boasting as the first digital platform in Singapore to offer online investment advisory to corporate clients, you can monitor and plan your portfolio holistically. It is 24/7 accessible online web portal. You can access it either on your desktop or even on your mobile phone. Exclusivity by tapping on your fund manager's capabilities, offering proprietary ETF selection and asset allocation view. Our credibility and track record of more than 30 years as fund management company, making us one of the most awarded fund management companies. So head to our website. The link will be shared in the chat box and later again at the end of the webinar to find out our latest promotion and for more information. So today we're attending this webinar called USD versus major Asian currencies. So before we start off, I would like to call out for our first poll, one and only poll. Yes, okay, so the poll question is, currently I hold which primary currency in my saving or investment accounts? Wow, there's a lot of Sing dollar, US dollar, other Asian currencies. I see Aussie dollar, for some Aussie dollar. No one holding Euro dollars? Right, okay. Right. Okay, so we can see that we will stop sharing and I'll show the results. So as you can see, a majority of you hold Sing dollar. There are a couple of you that holds US dollar and other Asian currencies. Wow, thank you so much for answering. Oh, is there an issue? Okay, sorry, no worries. So I can see the majority of you hold Sing dollar, US dollar, and other Asian currencies. So I'm glad. Thank you so much for answering your questions. Now, I think this topic is very important for not just corporate investors, but for also as a retail, to have a better understanding of how is Sing dollar going to be, how is US dollar going to be in the next quarter in 2021. So that calls for to introduce our guest speakers. We are honored to have two guest speakers from UOB Global Economics and Markets Research team. Our first speaker is Mr. Heng Koon. He is the head of market strategy in the Global Economics and Markets Research team at UOB, where he formulates forecasts and market views for FX, commodities, and interest rates. He has more than 20 years of financial market experience across the key asset classes. Good morning and welcome, Koon Hao.
Morning, Priscilla. Good morning, everybody.
Morning. And let me also introduce our second speaker, Mr. Peter Chia. He joined UOB in 2015 and is responsible for crafting FX, hedging, or investment strategies for UOB clients. He has more than 10 years of FX buy-side and sell-side experience. Prior to UOB, he worked in several hedge funds and international banks. Good morning and welcome, Peter.
Good morning, everyone. Thanks for joining in.
So we're excited to hear from both of you on your views on the USD versus and Asian FX outlook for the fourth quarter of 2021. So I'm just going to pass this over to the first speaker, Koon Hao, over to you.
Okay, just give me a minute. Let me just share my screen. Okay, Priscilla, just want to make sure everybody can see this.
Yes, you can see.
Okay, let's start. So good morning, ladies and gentlemen. Thank you for having us today. I guess this is a very opportune time to update on our currency outlook, given that market's a little bit jittery right now for various reasons. The presentation we've broken into two parts. I will start first, of course, with the obligatory discussion on the Federal Reserve monetary policy outlook and our overall US dollar outlook. And then Peter will pick up a little bit of granularity with regards to the Asian regional currencies like renminbi, Singapore dollar, so on and so forth. So you notice how Priscilla framed this. This is US dollar versus Asian currencies. I suppose I have the easy side of the stick in the sense that, the US dollar is always leading risk sentiment, is always leading the views. If things go very well, obviously markets expect the Fed to tighten monetary policy, like, a few days ago. And of course, the US dollar will do well. above all other currencies, right? So if things go badly, you have a contagion, you have a event risk, then of course things will go the other way, supposedly. But this is where US dollar as the world's reserve currency, this is where US dollar as the world's so-called safe haven currency comes in the picture. And if things go badly, US dollar will still do well as well, because everybody will flock back to US dollar as a safe haven outlet and to buy more US treasuries and keep the dollar strong. So is it that simple? Now in this cycle, things are a little bit more complicated. You have quite a few event risks across the cycle. So I will show these few charts just to put things into perspective, make everybody a little bit more objective and less emotional in terms of what's happening in the past few days. First, before we talk about the Fed's policy view, let's just review the commodities, the inflation landscape. So you have basically freight rates, from China to the rest of the world, literally shooting through the roof. And this is where you hear a lot about basically containers being stuck, at one port and taking 2 months to come back to Asia. And if you look at this, the price of shipping basically has not just doubled or tripled, it has more or less quadrupled, over the past year since COVID-19 has started. And this is that uniqueness about COVID-19. It does very different, very interesting things to the economy. Copper prices have pretty much more or less doubled from the COVID low of under 5,000 to around 10,000 per metric ton just at the middle of the year, and it's back down to about 9,000 on a bit of profit taking. And again, this looks very bullish, but you have what you call supply chain disruption, mining disruption, and that's causing a push up in copper prices as well. And this is something that you see a lot in this round of the economic cycle. Again, COVID-19 does very interesting things. Typically, in an economic recovery, you will find that it's demand-led price increases. In this case, it is both demand-led as well as supply deficit-driven, price increases as well, because COVID has basically changed, caused various complications to our supply chain. And of course, if you talk back about what's happening in the US, the good thing is that US unemployment rate is back to historical norms. Now, a lot has been said about the very weak payroll numbers that we saw just the other week. But beyond that headline weak number, you'll find that the unemployment numbers are all back to historical norms. And in fact, job openings have shot up to historic high. So this sounds a bit counterintuitive, right? Job openings in the US have shot up to historic highs, and yet the payroll numbers are lower. So how do you reconcile that? Very simply, for the lack of a better word, a lot of Americans have yet to get back to the job market. And as the economy reopens, you find that certain sectors are having job shortages. And you hear this evidence like truck drivers, for example, Walmart, they're all looking for jobs to fill. So where do we go from there? The US unemployment benefits, has so-called tapered off. That's their version of our JSS, and that has expired, back at the end of August. So you expect, a lot more Americans being encouraged to go back to the job market. So let's see how that works out for the US job market. Now, talking about the rest of the US economy, a key uncertainty is inflation. And why do I say that? Because, inflation has, for the lack of a better word, shot through the roof. Now, we all know what Jay Powell has said. Jay Powell says that, inflation is transitory. This is all low base effect and things will gradually normalize from here on. But the question is, how long before transitory becomes non-transitory, right? That's a big question. Is it half a year? Is it 9 months? Is it 1 year? It's a very subjective, decision. And why is inflation higher? Why do we think inflation may come back down? Or why do some who are much more pessimistic think inflation will shoot up further? In short, there's two dimensions to this. First is the very low base effect of prices last year. Now, we all know a lot of economies are shut down across the second quarter last year. So prices have collapsed last year. At somewhere around June last year, a year ago, people are talking about deflation across the world. The good thing is that didn't happen. So fast forward this year, that low base effect translates to a higher growth of prices this year. So that is fine. That makes perfect sense. Now, the other part, the second half of the equation is a little bit more difficult to so-called forecast and to understand. Simply that because, as I said before, COVID-19 does very unique and different things, to different types of the economy, and it's something that has not happened before. It has disrupted supply chains, from automotives to pharmaceuticals to shipping to mining, everything, even to food and beverage, you can name it. And as a result, it has triggered, spikes in prices and rise in inflation. So your price of computer chips has went up. Obviously, iPhones have went up. And the last time I checked, we're just preparing ang paos for next year. And the price for printing for ang paos this year is up like 15% compared to last year. So for that same material, relatively same nice design. So things like that. Prices have went up. And is this long-term? Is this transitory? That's that big uncertainty. So you see in the US, core inflation is up like 4% year on year. We've not seen that before in past few economic cycles. This is that recovery from Lehman Brothers. So you can put that into perspective. Headline producer price index in the US are at 9%. Same for China. And again, we have not seen that in past few economic cycles. And this is really, supply chain disruption. This is really higher commodity prices that have led to higher production prices. US ISM prices paid are all up, again, at multi-decades high. This is the job market being tight. This is prices being tight. And of course, I think this is probably one of the most important charts when we look at when forecasting monetary policy, forecasting US dollar and currencies for the next few months. Let me just take you through this chart quickly. So there's a few lines on this chart. The red line is your 2-year forward-looking inflation expectation for the US. And the rest of the blue lines are your 5, 10, 30 years. Now, don't worry about which blue line is which. Just focus on the red, interplay between the red and the blue. So you notice I draw a dotted flat line at 2%. That's your long-term inflation expectation for the US pre-COVID at 2%. So you notice on the left-hand side of the chart, anything before 2019, the lines are all below 2. Makes sense because that was the long-term threshold where anything above that, the Fed will start hiking. And that's your long-term inflation expectation for the US and for major economies across the world at 2%. Before COVID, red line is below blue lines. Makes perfect sense because red line is short-term 2-year inflation expectation. Blue line is longer-term 5, 10, 30 years. So short-term inflation expectation lower than long-term. Perfectly right. Now, look what's happened in the circle this year. This year, as the economies reopen, as we tackle COVID-19 slightly better, and you hear, of course, overnight that the US will start to reopen its borders, which is great news to those of us who are vaccinated. Now, you see that this year, the lines have all went haywire, right? All the lines are above 2%. That's because the Fed says that, they will take a bit of inflation overshoot. Some overshoot is transitory, but that's fine. And more importantly, the red line is above the blue line. And that has not happened before. This is where, market seems to disagree with the fact that is inflation transitory? Or is there a risk that there's a short-term inflation spike? Now, the next few months or for the rest of the year is going to be important. Will all these lines come back down to 2%, like what Jay Powell and the Fed says? Or will the lines continue climb higher? Will the red line continue to push higher? So that's the uncertainty we have to grapple with. And this obviously affects monetary policy, affects US dollar, affects the rest of currencies across Asia as well. Now, outside of inflation, you find that US house prices are at record high And if I can put it much more bluntly, back at pre-subprime highs. So this is something to take note of. And of course, this is the huge amount of liquidity that the Fed has pushed through financial markets since COVID-19 has started. Pre-COVID, the Fed basically has a balance sheet of about $4 trillion US. As of this morning, it is now just under $8.5 trillion US. So basically, the Fed's balance sheet doubled. In just 1.5 years, you have about $4.5 trillion US worth of liquidity pumped into financial markets. So just think of that number, $4.5 trillion US of liquidity. So where do we stand from here? We have a lot of debate whether the Fed will start to taper or not. And I think this debate is also the same, for any asset class you invest in, whether it's FX, equities, fixed income, commodities, so on and so forth. Now, on the positive side, right, meaning those factors that will encourage the Fed to taper earlier, and of course have a consequence on the currency market, is basically things like what we talked about earlier: inflation running amok, wage rises, tight job market, record high US housing market, and of course that $4.5 trillion of liquidity that the Fed has pumped the financial markets. Now, we've seen all the charts earlier on. Now, the uncertainties, the event risks that call for a delay in Fed tapering, that call for a delay in basically normalization of Fed monetary policy, is a bit more difficult to quantify. It's a bit more difficult to put on charts. First, you have that, very, very frustrating headline drop in non-farm payrolls. Will that repeat itself in September? Is it a sign that the job market is not exactly on very firm ground, right? Is it a sign of some structural worries about US? Then, of course, you have the uncertainty in the Delta variant, and now the Mu variant, the Lambda variant, you call it. You have, signs that, COVID-19, infection numbers are rising again. In Singapore, of course, we've broken the 1,000 daily threshold, and various countries, you're seeing a resurgence of infection again. Where does that lead us? Will that slow growth down, or will vaccination control the very negative outcome, the fat tail, of fatality? Will economy continue to reopen? Will we be able to live with COVID-19 under the new endemic world? So that's a key uncertainty. Now, in the US, specific to the US Federal Reserve, a big uncertainty is this hot, mash up of political uncertainties in the coming 1 month. There's three things that, US politicians, the House and the Senate, has to fix by the end of September, by the 30th of September. First is that they need to pass Joe Biden's infrastructure bill, Joe Biden's stimulus bill. Now, that's a total of $3.5 trillion. That's going to be a huge amount that will push growth and, of course, maybe trigger more inflation. Second, they need to basically suspend or extend the debt ceiling that has been hit. All of us saw Janet Yellen's piece on Wall Street Journal just yesterday. If the debt ceiling is not suspended or extended, by October, the US Treasury may run out of money, and technically the risk is that this may sound a bit ominous, but they may default, on their payments for US Treasuries. Of course, Janet Yellen has a lot of tricks in her bag, right? This may not happen anytime soon. It may drag on for months, but that risk is getting nearer and nearer. If you remember back in 2013, right, earlier on, there was a little bit of a debt ceiling debacle, and that resulted in the US being downgraded by 1 notch from AAA to AA by S&P. And that caused a lot of pain, of course, in the fixed income market as well. Now, at the same time, on top of Joe Biden's stimulus, Janet Yellen's debt ceiling, there's also that federal spending crunch. Now, every year, this is like, BAU for the US government now. The Democrats and the Republicans will fight, and basically they will refuse to pay, or should I say, to approve the federal budget for the next year. And every year you hear news of, some parts of the federal government being shut down, so on and so forth. So these three things are now coming to a head. And at No, this moment in time, the Republicans and Democrats don't seem to want to help each other out and are literally pushing things to the brink. So how will all this be solved by the end of September? Will that affect the Fed? Will that affect currencies? Is a key uncertainty. Of course, as I said earlier, the expiration of COVID-19 unemployment benefits has happened. That may push US, Americans back in the job market and may also form a new layer of growth. So the last bit I think I want to add is, of course, the latest contagion from Evergrande. We are all watching this, with very, very cautiously, and to see how that goes in terms of, Evergrande's development. And there's a bit of concern there may be contagion for financial markets as well. And that, of course, has an effect on currencies. So what will the Fed do? Now, our view is this, very simple. Tomorrow at the FOMC, we believe that it's about time the Federal Reserve should start to basically signal that it will taper at the end of this year. And once that discussion starts, basically, the process will take about 1.5 years. Tapering should end by middle of June 23. That's when the first Fed hike will happen. And December 23, that's where the second Fed hike will happen. So, and then from then on, the Fed should hike gradually across 24 and 25. So 3 key things to take note of here. First is, when will the Fed start tapering? That's end of this year. Second is, when will the Fed do its first hike? That's June 23. Third is, where will rates be, by the end of 25? And that's that big uncertainty. We see 2 hikes across 23. Beyond that, remains to be seen how strong the process of recovery for the global economies. So here's the catch. The US Federal Reserve most likely will be the very first, I won't say very first, but will be one of the first central banks basically to start policy normalization. And this is the catch. This is where US dollar strength comes hand in hand. Now, if you have read our view of our monthly report that were published somewhere around the middle of the year, our previous ones, you will find that around the middle of the year, we have changed our dollar view to one of positive US dollar. So this is important because the Fed typically will lead global central banks in cutting interest rates when there's a crisis, when there's a contagion, and the Fed typically will lead global central banks in hiking rates when things go very well, normalizing. So in this case, let's just appreciate that the Fed seems to be starting the process normalization. And once we get that clarity tomorrow, the process of tapering starts, the process of rate hike starts. So Fed Fund futures have priced in about 2 hikes, across 23, and that's as per our forecast. And basically, we see Treasury yields heading higher. So for the US dollar, this is my first and only most important message to all of you. US dollar is now around 93 on the dollar index, around 117 to the euro, and of course 135 to the Sing, so on and so forth. Peter will talk a bit more about US dollar to Sing and renminbi. But take note of this period here. Between 2014 to 2015, basically the dollar appreciated like 20%, 80 to 100, right? And the euro basically fell from about 140 to about 110. Now that's your inverse on this chart for the euro. Basically, dollar strengthened significantly. And that was the last time the Fed started tapering. That was the last time the Fed started hiking, right, in earnest. So this may well repeat itself. We are still very uncertain at this stage, although we think we have an idea where this is going, but we're uncertain at this stage because Jay Powell hasn't really committed to a tapering and rate hiking path. But we believe that once he comes out and the Fed comes out and state very clearly, okay, this is where we taper, this is our process, markets will then estimate when will they hike, the terminal rate, the dollar will strengthen significantly. So my message to you is the risk is that the dollar may well strengthen in the next 2-3 years. And that will basically drag the rest of the currencies along on a much weaker level. So just take note of this risk. In terms of dollar positioning, it has perked up very nicely ahead of the Fed announcement. And of course, outside of the dollar, 2 key currencies we look at, which is the euro and the euro rates are still stuck there. The Eurozone is still far away from normalizing policy. Christine Lagarde is still what I call, a very clear outright dove, right? Even where they hint of tapering, basically, Christine Lagarde says this is policy recalibration and it is not tapering. And that, the odds of, ECB hiking rates anytime, before the Fed is just not there. So you find that German bond yields are still mostly stuck in negative throughout most of the yield curve. And our view is that we see a weaker euro all the way down to about 113 by the middle of next year, from about 117 now, and about 157 against the Sing from about 158 now. Now for the Aussie, obviously the concerns over the China growth slowdown. Peter will talk a little bit more about that. Concerns over the recent iron ore sell off has started to weigh on Aussie. You notice that it's tapering off the Aussie against the dollar and against the dollar and against the Sing. And our view is that by the middle of next year, Aussie against the dollar should come back down to about 70 cents. Aussie against Sing should come back down to about 97. So before I pass on to Peter, just to summarize, three key things. One is pay close attention to where basically the Fed will start tapering and how long will the taper process be. And hopefully we should get clarity from the Federal Reserve on Wednesday night for Thursday morning. Two is basically appreciate that, big mash up of US debt limit discussion, federal funding, and of course, Joe Biden's stimulus plan. Now, how this gets passed or gets delayed will have a consequence on US monetary policy and the US dollar. Third is our view since June is that the dollar backdrop will be strong because we believe that this may be a repeat of some form in the previous tapering process and Fed hike process across 2013 to 2015. So on that note, thank you very much. I'll pass the time now to Peter to talk a little bit more about Asia and of course, the renminbi and Singapore dollar outlook. Thank you, everybody. Okay, Peter, over to you.
Thank you, Koon Hao. I think everyone would have benefited from Koon Hao's very short and succinct sharings. I think some of you may not be familiar with him, but for those who are familiar with him, you'll know that he's the face of UOB research in terms of, and you probably hear a lot from him. And personally, I also learned quite a few things from him time to time. But moving on to the Asia FX outlook, I think it's very clear that I would just like to point three key factors that is influencing or will determine how Asian currency will perform. And the three factors are, the first one, which is the virus risk. Yeah. So I think it's clear that in the last 2 years, everything is all about how COVID evolves over time and the financial risk associated with it. And after virus risk, the next risk is actually growth risk, which is quite closely correlated to risk around COVID. And the last risk to Asian FX would be that of the risk coming from the Fed normalization, which you hear a little bit from Koon Hao earlier on. So let's move on to the first one, which is in terms of virus risk. This chart is all about vaccination because to contain virus, the COVID virus, vaccination is seen as one of the key factor. And as you can see in the middle part of this chart, you can see the progress from of Asia as a whole. Compared to just 2 months ago, the current vaccination pace for Asia is about 33%. This is a big jump. In just 2 months, we went from like sub 10 to 33%. So this is already, you can see that there is this big effort in Asia in terms of containing or getting, or at least securing vaccines, getting into everyone's arms and to try to put an end to this pandemic. And as you can see over here, there are some countries that's doing a lot better. I mean, exclude Singapore, which is like 80%. Most of them were doing about 50%. Like that includes Malaysia, Hong Kong, Japan, Cambodia. But at the same time, there are also countries that are lagging behind, like namely Indonesia, India, which is still doing the 10%, and Thailand also. So be it how fast do the economy reopen, it all depends on the vaccination. So I think in the next couple of months, we should see all these bars starting to improve, but it will take time. I think it takes time for countries to secure vaccine. It takes time for it to be administered, and it takes time. You need to wait another month before you put in the second shot. So this is the start of I think we can all agree that we are seeing light at the end of the tunnel, but it'll probably take some time. Generally, Asia as a whole market is looking at possibly early next year to middle part of next year before we can really reach a certain amount of vaccination, or 70 to 80% as a whole, before we can say, okay, we can all lower down or reduce restrictions in a big way, and it's all closer to BAU again. So this is a key progress that we have to monitor. But as a whole, I think Asia is very clear that Asia is lagging behind all the developed countries like US, Europe, and a large part like UK. But there is progress, and we continue to think that there will be more progress in the coming months. But what's interesting is that in the last couple of months, despite what you hear about virus, a surge of virus in Asia, especially in ASEAN. I mean, in Singapore, we are no stranger to that in the last couple of days. But you see that on the contrary, this chart is all about mobility. That means, rightfully, when you see a surge in infections, you would think that mobility would be severely reduced, like what we've seen last year in March, where there is lockdowns everywhere. But what's unique in the last couple of months is that there is not much lockdown in response to the surge. And in fact, you can see that all these lines are trending higher. It means that, in fact, ironically, social restrictions are lesser and people are allowed to carry out more social activities, and they are more mobile. So it's this interesting thing, and I think this really sums up how regional governments are responding to the virus right now, because on the back of vaccination pace grinding higher every day, they feel that it is time to really loosen social restriction and to really find a balance between lives and livelihood. So this is what we are seeing right now, where activities are coming back in a way. So I see that as a reason to not totally write off Asian growth in the next couple of months. In fact, we could be closer to a very nice recovery into next year. Yeah, because as people get more mobile, they will produce, and the GDP as a whole for the region will improve gradually. So that is the reason why when we talk about virus risk, you can also sense that the rhetoric medically is getting worse, but economically it's not getting worse. In fact, compared to last March or early this part of the year, there is a big difference. So risk associated, or at least financial risk associated with the virus, is actually receding. So that's the reason why every day you hear about bad news about the virus, but currencies are stable right now because this risk is actually on the decline. But it's still worth noting, because if one day suddenly Delta overwhelm everyone as a whole, not only Asia, but the rest of the world, then this risk will pick up again. Next, we move on to growth risk, which is closely related to virus risk. Yeah, because in the last 2 years, if you have virus, you cannot grow well. Yeah, and that is true last year. As you can see over here, if you focus on the bottom half of this table, you can see that a lot of countries in Asia have recorded very negative GDP growth or contraction last year. But this year is all about recovery. No doubt that Delta variant is right now in the picture, complicating things. But no doubt this is still a very positive recovery year compared to last year. So I like to point out, like China is still growing at about 8.6%. India is still, for what you've seen so far, all the negative headlines, is still expected to grow 8 to 10% thereabouts. So it's still very healthy. And the rest of ASEAN, 3 to 5%, that is something that is above pre-pandemic levels. So there is risk to the downside in terms of growth because of the complexity or the contagions of Delta, but overall, we still think that this is a positive year. And more importantly, as we go into next year, as you can see the 2022, we are maintaining a positive momentum. So that's the reason why Asian currencies, or where we are right now, markets have not really adjusted or become very pessimistic about Asian currency at this point in time. So growth risk is worth watching, but it is not the key determinant of Asian FX, or the key driver of Asian FX right now. So your question will be, then what drives Asian FX in the next couple of months? And I mean, before we get to that, you can see volatility. There's a big spike of volatility in last March. And after that, you can see that because of the huge amount of liquidity being pumped in by the Fed and the global central banks, volatility is non-existent. We are back to where, as if the virus is no longer is not in the system at all. Give you some example. VIX, which is the darker blue line over here, is at 18. Below 20 is like there is not much volatility to begin with. And if you look at the lighter blue one, that's interest rate volatility, also very, very off the highs that we've seen last year. Asian FX volatility, the black line, has been gradually declining. It's right now less than half of what it was last March, and declining. The key thing is declining. So despite what you hear from me about virus and growth risk, which is skewed to the downside, investors are saying that I think we have to move forward, and we have to see what's ahead. And investors have not put in a lot of premium associated with the risk that's being discussed earlier. So in Asia, there is a big divergence in terms of FX performance, and I'll roughly divide it into two groups. Let's focus on the red color lines over here. These are the currencies that are not doing so well this year. Year to date, they are negative against the US dollar. So they're probably negative because of the virus and growth risk, that's one. And they are also negative because of the Fed normalization. This is another risk I'll cover a little bit later. So as a whole, these include countries like Indonesia, which is the Indonesian rupiah, the Thai baht, and ringgit. They are all slightly under the 100% mark, which is meaning that they are down year to date. And if you can see, there are also another group of currencies that is very, very resilient. And for whatever that you are seeing right now, they are up against the US dollar. I mean, we know that this year is the start of the resurgence of the US dollar, but this group of currencies have outperformed the US dollar. So they include countries like China and Taiwan, and they are still up against the US dollar at this point in time. And a lot of it has to do with how they handle COVID and how growth, because of their very successful containment of COVID, growth has not been affected at all due to COVID. So because of that, the currencies display the resilience, and they are up against the US dollar. So you have the very negative, you have the very positive, and Sing dollars is somewhere in the middle. We are slightly down against the dollar, but as you know, Sing dollars takes the price of its trade partners, meaning that if a majority of our trade partners, which is we have some trade partners over here that's in the red, so rightfully Sing dollars also is like the average between all our trade partners. That's why we are somewhere in the middle of this spectrum. Okay, so let's move on to the last risk, which I would like to cover in depth, and before we move on to the individual currency. And this last risk is what I believe will be the driver for Asian FX in the next 6 months. And that is the risk associated with the Fed beginning normalization. So you hear from Koon Hao that normalization could begin as soon as tonight, where the Fed begins the 2-day meeting. And by the end of 2 days, which is by early Thursday morning, if the Fed announces that, yes, we are going to start tapering at the end of the year, then that could be a game changer. And everyone's template to compare that, how would Asian FX fare in the when the Fed begins tapering, will be that of 2013. So just to refresh a little bit, 2013 was a very volatile year for Asian FX. And there's 3 key takeaways. I will just sum it up from the experience back in 2013. When the Fed announces that they will start tapering, Asian FX, the number one thing is that Asian FX started to decline. So that's one. That means they will start to turn from positive to negative. The second point to take away from then was that this decline carries on for a couple of years, as you can see over here. When Fed started to talk about tapering, you see that Asian FX as a whole started to decline and it started and it lasted for way like 3 to 4 years. And the last thing is that volatility will pick up in Asian FX. That means it is not it's not as still as what you've seen just now when you look at the volatility chart. So these are the 3 things that you should take away and be a little bit more careful when you talk about Asian currencies right now. So what happened back in 2013? The emerging currencies got it hit very badly. Like rupiah, rupee, Thai baht, and ringgit dropped in excess of 5%. Rupiah was the outlier, dropped almost close to 20% in the span of 6 months when the Fed talked about tapering. What's happening right now, ever since June, like what Koon Hao shared, was a landmark meeting, because June FOMC is the first time the Fed has started to talk about tapering. So, and from then you can see that Asian FX as a whole have dropped, but not very similar to what we've seen in 2013, where the drop is more widespread and a lot bigger. But right now, the biggest hit was the Thai baht, which dropped about close to 6%. The rest still okay. Sing dollars 1%, ringgit 1%. I mean, we can survive with that. But I think the key message from this chart and our experience back in 2013 is that don't be complacent. Yeah, it doesn't mean that currency haven't moved means that it will not move in the next 1 year. I think it is time now to really take a look at what will move in the next couple of months. And I'm personally a little bit more cautious about Asian FX as a whole. I believe that these bars will start to extend down, maybe not to the extreme from what we see in 2013, but it should get more negative going forward. But what's really pivoting or really supporting Asian FX maybe this time round, or making it less worse than 2013, is that there is a record FX reserve amongst Asian central banks. So that will help to cushion some of the outflow pressures that the central banks will face. So you also limit some of the downside for Asian currency as a whole. And let's move on to the last 2 things that I have for you, China and the renminbi, Singapore and the Sing dollars. So for China, you have seen a little bit from Koon Hao earlier. Things have indeed slowed down. Chinese economy is not as strong at compared to before, compared to 3 months, 6 months, or even 1 year ago. You can see over here, PMI has already sharply, more importantly, the non-PMI has already dipped into contraction territory last month. This is worth noting because ever since the recovery that we've seen in the first half of last year, PMI has always been above 50. It means expansion territory. But right now, we are seeing the first real sign that things are really slowing down in China. So it remains to be seen whether this is just a blip, will it rebound after that? But at least it gives me a sense of caution that we should at least not be so positive about China and its economy going forward. And the signs, there are even more other signs. I think you've seen this chart from Koon Hao. Retail sales last month was the big thing, which is the blue line over here. In just the span of 1 month, from 8.5% in July, it dipped to 2.5% in just 1 month. So that is a big sign. Why is it a big sign? Because China is all about consumerism, especially where it decided to shut its borders. The only thing that can support the economy is its own people buying things. If they are buying at 2.5%, can you imagine the stress in the economy right now, or at least the stress that's building up in the economy right now? And GDP, we believe that the best days are over for China GDP. In the first half of this year, we've seen the China GDP as a whole grow at about excess of 10% on the first half of the year. In the second half of the year, we are seeing that it will grow at around just below 6%. So you can see that it's about half the rate in the first half. And as a whole, for the whole year, we see that we are probably growing at about 8.6%. Pretty decent, but we have recently downgraded it from 9.1 to 8.6. So after seeing what we've seen in all this data. So the key picture, I think the key message I want to send is that China is not as strong as before. And because of that, there will be downside risk to the currency. As you can see over here, the currency is very strong. We focus on the light blue line, which is the Fbx RMB index. This is the performance of renminbi against a basket of all its trade partners. It is at least a 6 years high right now, which is a light blue line. But you can see against the US dollar, it is also at a very strong level. But you can see that it is not going stronger anymore compared to what we've seen the dark blue line in the last 6 months or so. So I think this could be the turning point everyone is looking at. Right now, it's currently about 648 thereabouts. I think the next test will be if it goes below 650, then it could be the turning point everyone is looking out for. So if it breaks 650, I think all eyes will be peeled whether the downside for renminbi will start to accelerate. And as you can see over here, in terms of interest rate differential, it also doesn't make a lot of sense to be long renminbi because the gap between the US Treasury compared to the Chinese government bond has already narrowed a lot. That means the US Treasury yield is catching up on the Chinese government bond. So we believe that the dollar CNY should turn higher from here, and we have already seen the base at around 640. So if you are long on renminbi, I think it's time to take some profits around here and expect the dollars maybe to apportion a little bit more dollars into your portfolio going forward. And lastly, I'd like to touch a little bit about Singapore. Singapore is, you can see that we have the top part of the chart is about growth. We have recovered in terms of GDP back to where we were before the pandemic. So, but it is a very strong recovery nonetheless. But inflation-wise, we are not there yet. So this is the reason why, I mean, we also have a 2% target per se for MAS before they start to tighten policy. So currently at about 1% for core inflation, we are not there yet. For in the next month, October, where MAS have a meeting, we think that MAS can afford to stay unchanged in this policy meeting, and probably the next time they will tighten policy will be 6 months later in the April meeting. But for now, MAS unchanged. What does it mean for the Sing dollars? It means that with the unchanged setting, it means that Sing dollars as a basket of currency will be not appreciating. This is what it was. This is the performance of the Sing dollars against a basket of the currency. As you can see, long-term structurally, Singapore to attract investments, Singapore has always positioned that the currency is always on a gradual uptrend against most of its current trade partners, as you can see over here. But since the pandemic, the MAS has allowed the Sing dollars to hold steady. Yeah, it means at a 0% appreciation stance. So I think we will see this stance for the next 6 months into next year. And if the economy does improve or continues its very strong recovery, then I think MAS will have the confidence to really resume this uptrend. So what does it mean to you? It means that it makes a lot of sense for you to hold Sing dollars as a big portion of your currency, because the long-term trend is always up. And when things are, then when you need it to invest, then you start to change it to other currency like US dollar, which you believe will appreciate from this current level, which is the last and final point I have for you. This is the chart for dollar against the Sing. We believe that we have seen the bottom at around 132, and it's very clear that we have lift off from the June FOMC, and we will continue to lift off because we are in the midst of this broad dollar trend. Yeah, so we are at the start of this dollar rally. We have to be patient for trend to develop. Yeah, so my advice for you, if you do not have any dollars that you need to buy to invest in UOB AM funds, it's a good time to consider dollars right now. And with this, I leave the time to Priscilla. Thank you.
Thank you so much, Peter and Koon Hao, for your presentation. I think we learned a lot. There is still the light at the end of the tunnel. And yes, we are in a recovery year. And also that we have to be cautious for this year. So now it's to the most exciting part of the webinar, the Q&A section. For those who have missed out on the housekeeping rules, you can post your questions in the Q&A by selecting the Q&A icon showed on the control panel. You can even upvote your questions raised by other attendees. So I would like to introduce our moderator. is Mr. Lim Beng Yu. He is he's responsible for corporate and regional institutional clients, as well as the ESG champion of BD for UOB Asset Management in Singapore. He has a extensive many years of 25 years of wealth experience in the financial industry. So I think he's a good representative to be a moderator to pose questions to our honored guest speakers. So let's welcome Beng Yu, and over to you.
Thank you, Priscilla. We have over 300 who have dialed in today, so I think thank you for your interest. And Q&A stands between lunch, right? But I think we've seen interesting views, heard interesting views shared by both Koon Hao and Peter. And we've got actually quite a number of questions coming in. We'll probably overrun a bit over our scheduled time of 12 because of, I guess, the interest in the topics by both the speakers today. But first off, right, given what has happened in the past week, and I think we can't avoid this, right, China Evergrande, the spillover is impacting the rest of the property and banking sectors. Maybe Peter, how does this reflect on your view of China's growth outlook? And then maybe I'll get Koon Hao to add, right? How does he see this impacting the US dollar?
Yeah, so I think at least on a top level, we can see that Chinese economy is indeed slowing, and some of the problems with Evergrande is probably because of leverage. And I mean, the government stance is very clear. We are in this multi-year structural downtrend in terms of a new loan. So, and in terms of real estate, I think the government has also taken a very strong stance. So, not only in real estate, I think we are seeing increasing evidence that other parts of the Chinese economy has slowed down. Like what I pointed out, retail sales 8.5% to 2.5% in just a 1 month is a bit concerning. So the bigger picture, yes, we are of the view that China will slow in the second half. The question is, how much would there be? In fact, we have recently highlighted that there could be downside risk to our current set of forecast for the second half of this year. So I think it is right now time to be cautious about China as a whole. And because of that, we are also fairly confident that the renminbi will start to give up some gains starting from now against the US dollar. And also there's a lot of room in terms of the trade basket that the renminbi can pull back. So I think that will probably pan out in the next couple of months or so.
Okay, so on the, how should I say, the spillover effects of Evergrande to the US dollar, basically, I think the key question to us is, will there be contagion risk? Now, I know the past few days, particularly yesterday, has been a little bit, how should I say, unnerving on the equity markets, particularly out of Hong Kong. But, if you look broadly across key indicators in the financial market space globally, there's little in terms of contagion at this stage. For example, if you look at what the Fed looks like, the various liquidity indicators, they are still functioning relatively well. I look at 2 or 3 things. One is, of course, the treasury market. Second is repo market and the US dollar. These are still moving within, reasonable bounds. Now, assuming if, let's say, that's a big if things do go wrong, obviously, specific to the US dollar will be a key beneficiary every time there is, a big risk event or contagion. For example, when COVID-19 first hit financial markets, you actually had a few days of dollar strength. That's because everybody was going back into the embrace of US treasuries. Everybody was, liquidating risk left, right, and center, and back into the US dollar. That's your first port of call. So that will be the first sign to look at, if the dollar starts to strengthen significantly against renminbi, against regional currencies, for a little bit more dollar strength.
Okay, thanks, Koon Hao. Maybe staying with you, right? You mentioned that inflation, could it be transitory? There are some signals that maybe it's more widespread. What about inflation hedges like gold or even silver, right? And there's even talk that the US Federal Reserve, right, may even launch a digital e-US dollar, right? So is there an impact of all these digital currencies by central banks, right? Will that, and how will that affect investors?
Okay, let me talk about, there's two parts to this question. Let me talk about gold and silver first. Technically, gold and silver will be very useful inflation hedges. If again, for the lack of a better word, inflation does overshoot significantly and investors lose confidence in monetary policy setting from the Fed. So that's your worst case scenario. If you lose confidence in monetary policy setting, if you lose your purchasing power, your confidence of purchasing power, you need to go back to hard assets. That's where real estate, that's where gold and silver comes in. At this stage, unfortunately, gold and silver are feeling a little bit of the pain from your upcoming normalization of monetary policy. Now, you notice that since June, right, gold and silver went nowhere except that it's trending lower. Most of the selling hasn't been very well absorbed. Gold has fallen below 1800, 1750, 1760, so on and so forth. And silver is back to the low 20s. That's simply because of the expectation that the Fed will likely taper by the end of the year, give or take a few months, and the Fed most likely will start hiking, late 22, mid 23, depending on how hawkish you get. So as this process of normalization start, the first knockoff effect is a weaker gold and a weaker silver until the market finds an equilibrium again. Now, on basically your digital dollar, that is very interesting. Yes, there's a lot of whispers out of the US that regulation will come on, to basically try to form a bit more order in the cryptocurrency market. And the Federal Reserve, particularly the Atlanta Fed, is working with MIT on what you call a digital US dollar. It's still a lot unknown in between all this. The last time Jay Powell talked about this, there should be some form of announcement this fall, and we look forward to that. And at this stage, I would say, the eyes will be more on the 数字人民币, the digital renminbi in China, because China is way ahead of the pack, and they're likely to do much, much more significant public trials, in Beijing at the upcoming Winter Olympics next February. That will be the one that may drive the dynamics. Thank you.
Okay, thanks, Koon Hao. Maybe moving to, as you talk about the China e-currency, right? Moving to Peter, right? We've seen, as you've shown in your presentation, right? The Asian currencies, some have fared better, some have not. What could be a surprise Asia FX move, right? That you anticipate or that you could expect to see in the next 6 months?
I think the surprise is that of the renminbi, because we have been stable for so long. And I think particularly across in the third quarter is like when the whole world sees the surge in COVID and whatnot, people are repricing the US Federal Reserve in terms of tapering. The renminbi is like in the 2% range throughout this last 2 to 3 months. So I think if there's a breakout, I think that will really surprise everyone. And once, I think the key level which I highlighted is 650, 652 thereabouts. If we do take out convincingly that levels, maybe coupled with some negative news, I think the movement could be quite rapid. So keep an eye for these levels, because for such a big currency, it is very unusual where there's so much latent risk in the system and it's not pricing at all. Yeah, so keep a lookout for the renminbi.
Okay, thanks, Peter. We have a question, right? I think both of you, right, Peter and Koon Hao, you talked about the Fed meeting over the next 2 days, right? And the expectations on when tapering will start and when interest rate hikes will increase, right? There's a question about what do you think will be a critical reason or indicator that forces the Fed to accelerate its rate hike prior to late or mid 2023, late 2022 or mid 2023. What do you think would be the factor? And maybe I've also a follow-up question, right? It seems like the market expectation is for the Fed to announce in this meeting that tapering will start in in end of the year, etc., and the rate hikes, about 15, 18 months down the road, what would need to be seen, right, for the Fed to change its mind, either to delay tapering or even unlikely, but to bring forward tapering?
Maybe I'll start first and then Peter can add on to that.
Okay.
How should I say? Now, the first question about what will force the Fed to accelerate tapering. Consensus is that, and our view is that the tapering process will take 1.5 years, and first hike will only be in the middle of 23. It's a slow, steady, calibrated, cautious normalization. So what will force them to speed things up and hike, let's say middle of 22? One word: inflation. And again, I saw some questions on inflation in there. We don't have time to address it, but there's a huge debate on whether inflation is transitory or not. There's a huge debate on what is a definition of inflation. And this is either, there's no sitting on the fence. Either you belong to, so-called Larry Summers camp, where you think inflation will hit you like a brick wall, and we will need to worry about it next year when the Fed surprise with rate hikes. Or you belong to Jay Powell's camp where, this is transitory, this will all pass, this is fine. And I would say if inflation does have a bit more longevity, if Biden's stimulus plan does get pushed through and that causes another wave of job market recovery, another wave of demand, you're going to find things will heat up a little bit more than comfortable.
Okay, Peter, anything to add?
I think the only thing I can add is on communication. The Fed is always being, they pride themselves as being to give the market enough warning. So I think the concern of the market, or maybe from the Fed, is that right now where the market is fairly hot right now, and if they do not start this process, then when will be a good time to start this process? So communication, they already started to communicate that they want to start. So I think reputation-wise, and also that it's very hard for them to say, okay, we will change any of that. So, and I think there's also a minority within the Fed that says that there must be also some time between tapering, the end of tapering to the start of the rate hike. So they also have to factor that into account, and when they determine the pace of the tapering, because if they do too slowly, and they still need to leave that gap between that and before the first rate hike, then the whole process will be too long, and they could have missed this economic upturn altogether, and they will not want to do that. So there will be a lot of thought process behind that, and I think it's only right for them to really kickstart tapering this year.
So Jay Powell, if you're listening to our UOB AM webinar, communication is important. Please communicate.
Okay. So I think we've run over time. I think we'll end here. I think there are a few other questions, but we'll take that offline. But I think, to me, the two things that we really have to watch out for is actually, the Fed meeting over the next couple of days, and keep close watch on developments emanating out of China, and see how that impacts the rest of the world. So these two things, which are topical and I guess key for the next couple of days. Back to you. Thank you, Koon Hao, and thank you, Peter. Back to you, Priscilla.
Thank you so much, Beng Yu, for being our moderator, and to our speakers, Koon Hao and Peter, for sharing your views with us. I think the audience here have learned so much. So I'm just going to share my screen, just the last one. Apologies, audience, for overrun. However, we're just going to share a couple of things before you go. So I'm going to share my screen. Right. Okay, so at UOB AM, we want to partner with you in your wealth management journey and leverage on technology to allow us to bring you a simple, safe, and smart way of investing. Do check out our UOB AM Invest corporate website to discover more about UOB AM Invest, and not forgetting our UOB AM funds, which are available in both Sing dollar and US dollar. The website link will be imputed in the chat box. Please keep a lookout for our future webinars coming up. Greatly appreciate if you could leave us a feedback by clicking on the feedback link. Now, before you go, we would like to wish you and your family a happy Mid-Autumn Festival. Thank you for attending our webinar. Stay safe and see you on our next webinar. Take care.
Bye.
Thank you, everybody. 中秋节快乐。